all my niggas in the city. This shit really for Queens, though. Really for Queens, though. You know? Big city of dreams. Motivated by skating. Getting money regimen with my getting money machine. Now I'm in. Yeah, New York Times, come listen to these New York rhymes. A southern nigga with a New York mind. In the concrete jungle of Queens trying to be kings. Getting to the money it sings by any means as I watch it all pan out. Try not to stand out. Fish out of water, get an official reporter. Up here, life is a bitch. I blow a kiss at her daughter. In the city with niggas that leave shit out of order. So yeah, you heard the news, disturbing news. Shot the hit brother in their head, thank the Lord he ain't dead. Was in a coma for months, eyes ain't opened up once. My nigga visibly stressing, the mess he smoking his blunt. What could I say? I can't relate to that. All I do is pray for that. This is shit God told me gon' make it at. I got a date with destiny, I'm running late for that. Grab a paper, hey kid, you gotta pay for that. The New York Times. Yeah. The New York Times. You can win anywhere. You can win there. And you ain't been nowhere. You ain't been here. It's so hard, yeah, really in the game, man. Same place, different faces on the train, man. New York. Back on the F train. Took the express train. Skip that local shit. My vocal sick. That's how success came. Once kings, now we pawns in this chess game. Wall Street got black slave blood stains. Which means we built this city and never got scraps while the devil got fat. In fact, reparations for niggas in desperation. Fuck money, give my kid a real education. Blood money spills had a real revelation. Southside make you realize it's still second out loud. Sometimes I wanna say the world and I be thinking about how my motive to lead my niggas to paradise. Imagine a world free from pain and we no longer scared at night. Far from the crime, the blind leading the blind. We don't make the prime time till we die. The New York Times. The New York Times. Yeah. The New York Times. Extra, read all the baby. You can win anywhere. You can win there. And you ain't been nowhere. You ain't been here. It's so hard, yeah, really.
Last song, and we'll get this started. Waiting for one more to come, and then the party begins. Very excited to have Robert Heimowitz here. He's a housing analyst. Great guy. Dude hits home runs. Last time we talked to him. Bring a pencil, piece of paper, take some notes.
Stressed, so fuck it, I'm a doctor, self-medicated. Trail and champagne flutes and I ain't celebrated. Been up crack, presentations, everything, so I wait till I played it. Patience, I'm fake, like outdated. Dinner, hearing it like this, about as rare as cicadas. The boy got some Miles Davis in him, all that jazz. Telling all that truth, nigga, talk your shit. Better watch your mouth, better watch your back. Better choose the right way. I'm working the road shit, and of course, the path less traveled. Fuck, I look like following your footsteps, don't fumble.
So with that, let's get the party started. Real Assets Weekly. Weekly is, of course, more a colloquial name. We don't actually do it weekly, but Jimmy Wang usually and I do these. He'll be popping in here in a second, I believe. But let's go ahead and get started. Robert Heimowitz, the home builder homie. Home builders obviously are, super interesting cyclical stocks to watch. Robert covers them professionally for a fund. So guy really knows his stuff. Lives in Miami. Great guy. Friend of the show. Friend of probably a lot of ours here on Twitter. And great opportunity to kind of pick his brain. So Robert, happy Friday. Or excuse me, not Friday. It's feels like a Friday kind of Tuesday. It's been a long week already. How are you?
I'm good. Thanks for having me. Happy to share my knowledge. I've spent a lot of time accumulating it, so this is almost like it's nice that someone cares.
It might just be me, but somebody does care. For sure. Like you had said, I mean, geez, man, we had like a couple hundred views on this YouTube Zoom call we did earlier, and we'll pop this up on the YouTube channel, Swami Research YouTube channel, when we're done here. But a couple hundred views, a lot of alpha per click, a lot of alpha per view. It's funny how that works. You got to go where the looking for alpha on the internet. You got to go where not everybody's fishing, I guess. You're not going to find it in Mario space.
Yeah.
You're gonna find it in this one. So with that, let's get into it. So maybe just start here. So I thought it was I was listening to our last interview, and what was interesting that I don't feel like I just starting in home builders in general. So you kind of came the traditional route, but give me a little more color on why home builders. I know you started on the IR side itself. So like, what was interesting to you about the home building business?
To be honest, I didn't choose the company because they were a home builder. I chose it because of the employment track. It allowed me to get into corporate finance, which was something that I found interesting. And yeah, I eventually made it into an investor relations role, which basically, is the other side of the coin of investing. So, investors are basically just looking to see if the corporate finances add up at the end of the day. So, whether it's communicating investors' ideas to management or just working on actual corporate finance projects internally, I got great experience and I became a specialist. And I eventually moved over to the buy side. And, I don't just cover home building and real estate, but it was a way for me to make an immediate impact on my firm, and it's been a positive one at that. So very thankful for the opportunities that I've had, and just try to put my head down and produce returns.
Yeah, and so there's a lot. Is it true that there's a lot of that's kind of like there's a lot of home builders down there where you're at in South Florida, correct? Like several of them are based out of there. So is that your or is
Yeah,
that
look,
not?
I always joke that like 50% of the Florida economy is real estate. My whole network is really in real estate, and that's not strictly home building. That's a lot of brokerage as well. But the Florida economy is heavily influenced on real estate. So that's just a matter of fact. And, a lot of capital finds its way to Florida from around the world, whether that's Russia or Venezuela or China or maybe more legitimate places, which is more through migration. You see a lot of Europeans come here, and even people from Turkey. So Florida is a pretty international market for real estate.
Yeah, and definitely it's much less international probably, but in SoCal I would say it's very interesting. I don't know how the numbers break down, but it is such a lot, so much of the wealth in the affluent, so much of the wealth in the affluent areas is housing price appreciation, and it's just such a rigged game, right? Because in Southern California with Prop 13, we talk about Prop 13 a lot, but it's like the essentially that means that if you it's a limit on how much your property taxes increase. So if you bought a house in 1970 and your tax base was 200,000, then your tax base is still only gone up. I think it's 2 to 3% a year since then, while your house has appreciated at 15% a year since then. And so you get these situations where people move into neighborhoods and they're paying the annual property tax that somebody's lived there for a long time pays in a year. They're paying that in a month, and I'm not making that up. That's happening in a neighborhood I live in. Where the next door neighbor's paying it's crazy what's happened with Southern California real estate. And so, but maybe here's an interesting place to start. So I think housing price appreciation was a big part of maybe the resilience of the American consumer. How how is the like Joe six pack that owns a home? Do you have insight on like how they're doing relative to maybe when we spoke last? One more sentence here, Robert, is last time we spoke, you said, and you we'll go back to the call later, but you crushed the call. The call was, look, home builders have never been stronger than they are right now. That proved to be very true as the 10-year bounced back below 3.5. Since it's retraced back to 4, that's been tricky for the home builders. But so the question is, how are the home builders now? And then maybe let's start here though. How is the consumer? How is Joe Sixpack with his housing price appreciation still way up from COVID? And he locked in a rate at sub 3%. So he's doing good, right?
Yeah. I'll start with the comment on the builders never being stronger. That was more of a comment not on the stock prices, but on the balance sheets, right? I think some of the big builders might have even got to negative net debt. And, like real estate is an asset class that's meant to be leveraged up. It's got collateral and a lot of reinvestment opportunities in home building, or, this office investors who paid peak pricing got in trouble. But, when you have cash flows, it's very, very common that people lever those up as long as, the income is more than the interest payments. So those are the debt on the builders is actually at all-time lows. And then another piece of where their operations were better positioned to outperform is still true in my mind is that, they can buy down interest rates. And so that interest rate buy down is actually pretty big. And it leads to, an arbitrage where if you're buying a new home and you are dealing with Joe Sixpack, who you mentioned, who it's like he gets one chance to sell his home for the most money possible, or you're dealing with a giant home builder who's like, hey, I got to hit my sales numbers this month, and and they're incentivized to sell X amount of homes, then you're going to get a better deal from the home builder on price, but then you're also going to get a better interest rate because, I've heard of this happening in the existing market where people buy down the buyer's rate, but like realistically, that's not something that every single person's going to do. That's more of a case by case basis, whereas it's like a real program. Now to Joe Sixpack and how he's doing just overall. Look, it's like Joe Sixpack, if he's got an under 3% mortgage, has a set of golden handcuffs, right? Like he's not going to move if his payment's going to more than double, and even if he needs more space, if anything, maybe he'll rent out another home and then in turn try to rent out his original residence without selling it, because to give up that type of rate, you frankly you might need some brain damage, because it realistically is something that was, the American mortgage market is a unique animal across the globe. I don't know that there's anywhere else with 30-year mortgages. Most people need gifts from their families to buy a home across the world. And, you're kind of on the one, you're already structurally advantaged with having a 30-year mortgage that amortizes over the life. But the next piece is that, like when interest rates went to zero, like I know there's like a lot of like MMT people who say it's just an asset swap this or an asset swap that. But realistically, like it feels like rates were dragged down to zero, and everyone who got a mortgage near there is really benefiting in real terms today. So I'll just leave it there. And I'll actually add one more point. I always tell my bosses when they're asking me what's the risk, what could go wrong, I always say that like a huge recession or depression with job losses, like I'm not taking responsibility for that. At that point, we need to reassess the whole thing and see if we still want to be in these positions, because I am scared of Airbnbs coming to market and stuff like that and forced sellers. But like in an economy, like we're in, like even a mild recession, I'm not scared, because a mild recession, like when I think back to like the tech bubble, like home values didn't necessarily do that bad. They might have even went up, excluding California. So, everyone likes to fight the last battle, and that's what I like to caution people against is saying like, hey, like the last recession that you remember is 2007, 2008, where home prices cratered. So let's structure our entire thesis around that. That's not how the downside would work in a realistic scenario.
Yeah, I think it's pretty safe to say, hence the pinned tweet that I just threw up in the nest, that you actually sent me this Bloomberg Markets. Like, to your point, it's just such a non-traditional cycle through and through, right? And so we have Bitcoin as the safe haven asset. The new blue chip is a profitless, car company, or there's some profits there, but not much. And now EM debt is yielding less than the U.S. Treasury, right, in local currency terms. So to your point, it's whatever happens next, it's going to look different than the previous cycle would probably make sense. Jimmy, what's up, man? Welcome to the conversation. Good to see you sliding in. I know, hey, we're both on commission, so it is what it is, bro.
Good morning, Turtle. Hey, Robert, what's up, man? Thanks for joining us. And I'm going to piggyback on your point. We all got sales quotas to make. So excuse my tardiness. I had to get that paper. But what a wild time we live in, man. We just got a lot to talk about. I know you guys started talking about some stuff, yields. And, if the Fed can change the rules and they can buy corporate bonds, like, why can't I find the regional bank that has my 3% mortgage that's now trading at 55 cents on the dollar and buy back that own debt? Are there any other ways to take advantage of that below market rate that's now an asset working for me? I do agree with your point, though. I don't think people are moving anywhere now. Someone else was posting and you were like, no, is like, I agree. You have a levered asset that has a lot of risk to the equity. And if that asset is not appreciating, we don't make those home buying decisions always to min max our personal finances. These are emotional decisions, right? These are lifestyle decisions. So I don't see most people moving just because. But there might be an opportunity, like you said, if you can rent out your property and collect a market yield, and have someone service your debt and then some. Maybe there's other things to do. But frankly, I think just a lot of people are stuck with their homes. So get used to it.
Yeah, and that's something that I really want to stress. Like the existing home market is not the new home market, and so even if both were to shrink, the new homes are going to pick up market share at the end of the day. And like Airbnb is a risk, like that, like all these people Airbnb'd, but at the end of the day, like you read a lot about how people aren't vacationing to these rural areas where a lot of these Airbnbs are, and like how they were hurt this year when people returned to Europe after being locked indoors forever. But it's really just not a risk that's materialized, and it's frankly something that if you have it at 3%, like it's not the worst deal in the world. And that's still just like on the margins of the home market. Like I actually saw something that was like really interesting to me when we think about this is that the single family rental companies, I saw an article in the Wall Street Journal that was saying that they've actually, like, as home values have went up so much, they've actually shrunk their portfolios and they've sold some homes out into the market, which to me was fascinating because, I mean, if you know the rule of corporate America, it's like you grow at all costs. Like investors only want to own companies that are growing. And so the fact that they like prune their portfolio and they're waiting and looking for, you can bet that they're waiting and looking for new ways to grow their portfolios. They just said like, hey, look, the cap rates that we're getting on this are obscene and we need to prune these properties, which is another way of saying that those didn't make sense as investment assets anymore. They probably made more sense as people's primary homes. So they sold them. And so, as we look through the market, it's an interesting phenomenon. The the tweet that I quoted specifically that you're referencing, you know, I I I happen to follow the guy like not that closely, but you know, I've noticed over time he is a real estate investor, like at like some sort of hedge fund or mutual fund, and
I know him
he moved
personally,
out
by
of
the
his
way.
primary he moved out of his primary residence. He even quote tweeted it underneath and said, "This isn't my primary residence anymore." And so he, you know, maybe he's of a different generation than me. Like I know like my parents don't want to Uber, or they don't want to they don't like sharing their goods. They don't care about like maximizing utilization of their properties. Like that's not why they buy things like people in our generation do. Like I happen to know a real estate broker who owns a G-Wagon that puts it out on some app so that he can earn cash on it. Like that's just not how my parents and some older people were wired. And so maybe he's carrying a home at a 3% mortgage that he doesn't want to rent out to someone else, but it's his primary residence and he's moved in the meantime. And so for him, he sees it as a negative cash asset. But you know what? Like I'm going to play the world's smallest violin for the guy. Like it's like you have a preference, and I'm making an assumption here, to not rent out your home, and then you're saying that it's not a great investment. It's like no one's forcing you to hold a negative carry asset. So, I mean, like he's also just a very smart investor, by the way. But yeah, I mean, I just think it's like you taking your personal preference and like stamping that as like it doesn't make sense to have a 3% mortgage when inflation is higher than your mortgage rate. Just it doesn't make sense to me. Like we have uh what's the word? We have essentially a government funded financing in the mortgage market, and you're complaining that you have like extremely favorable financing. I'll break out the smallest violin for you.
Yeah, no, I think that makes a lot of sense, and I think that I mean, it didn't seem like overly like brash your response or anything. I thought it was, I think it makes sense. I think and to your point, I think he's a very well regarded guy on Twitter that if you can't, he seems like a guy who's totally fine being pushed back with him. And the guy's stuff is very wide reaching here on Twitter. So good for him. I would say that it sounds like, I mean, what he's saying as a generalist sounds almost like consensus, right? It's like, yeah, why would you'd have to be an idiot to give away or to give up your, or tell me, push back on this or tell me what you think about this. But what he's saying is what I grasp it is you'd have to be an idiot to give up your 3% mortgage. And I think that is consensus. And I think, but it's also funny that, consensus continues to be, a very bad place to put your chips. So I guess my question, so basically, would you say that's framing it fair? Like his argument is nobody's going to leave these 3% mortgages. And your argument is basically they might have to. It might not be, I mean, to your point, like, yeah, you might not ever have to. And you're going to be one of those people that can rent a home. But a lot of people are not going to be landlords. And if they are, they're not going to be good landlords. And that's probably going to end poorly. So basically, yeah, is that a fair? Am I framing the argument okay? You think?
I just want to chime in real quick. I think it's Twitter, and if someone's like, "This is Cope," by the way, it's hard to know if people are sarcastic or not.
Not all at once. Maybe I killed the conversation. But who cares?
Can you hear me? Okay.
What? You guys hear me? No.
Yeah.
Oh, okay. Yeah. Go ahead. Any thoughts on that, or
yeah? I thought
move on to something else.
Yeah, I think Turtle might not be able to hear us, but we can hear him. But
Turtle, can you hear Jimmy? I think you can hear me.
Oh, no, I can't hear Jimmy. That's the problem. Jimmy, can you drop down real quick? Pop back up. Sorry, dude, I cut you off.
Jimmy,
there you go. We'll get Jimmy back up here. He's gonna come right back. Go ahead.
I was just trying to say that having a 3% mortgage is and owning a home on it is in 99% of circumstances going to be a good trade. And the thing is, most people don't think of it as a trade. And my number one fear, which I think you did highlight, that would lead me to change my view, is that like we have a not a recession, but we have a great recession that forces people to sell. And in that case, yes, I could see people selling. But if not, like, I think you'd be smarter, you'd be better off if you need to move your family because you have too many kids for your current house, you'd be better off renting another place and actually renting out your primary home in that scenario. However, you know, yeah, I'll just leave it there. I think that covers my view.
No, I think that makes sense. Jimmy, I'm sorry, did I cut you off?
No,
Go
thanks for
ahead.
having me
What were you
back.
saying?
Yeah, I've had some audio issues. I mean, you guys ever see that Onion article back in the day about Obama visiting the Denny's and like resetting his expectations for Americans, right? Like, I got a bunch of friends who are smart people, well regarded. This girl, she left her sell side job and she didn't log into her 401k for like 6 years. You know, like again, I do think that there's a min maxing component to all of this. And if I have an investment that looks like things might kind of crater if things continue to go the way they go, then I'm putting in a stop loss, right? But we don't put in stop losses for home property appreciation. So if someone's got a nice low basis, they saw their home value skyrocket, they got a bunch of equity, and they have a nice 3% mortgage, yeah, they're probably not doing anything about it. You know, and even if the home retraces 10%, right, in real terms, like that could be 50 grand or more in real terms. But, you know, I just don't think the market in aggregate works that way unless you have a catastrophic type of credit event that forces people to sell, I think, like you said. But, you know, yeah,
Well, oh, just real quick, and then we can move on to talk something
sure.
else. But just real quick addition to speaks to that would be like back to AMH and INVH. I mean, these guys are down 30%, right? So to your point, like that's a portfolio of single family rentals. That's, you know, obviously it's a traded ticker, but they're both down. Well, AMH down 20, INVH down 28. So
And I
point
still
being,
think they're
like if those guys,
expensive.
right. But I guess so that's what's just kind of like baffled me the whole time is like this thing is down 30. If I have 6 rentals, I live here in town. I'm Joe Schmo, you know, Joe, not Joe six pack, but Joe, you know, Joe six pack's dad, Joe 12 pack. He's a baby boomer. He's like 65. He owned a business. He has 6 rentals. He's flat, man. I mean, he's seeing, you know, his estimate is all time highs, and my portfolio of AMH is down 30. Like, how is that? You know, so I guess my question is, do you think that's weird? And do you think that that gap closes? We kind of talked about this we've talked about this before, but I'd love to hear kind of your thoughts on that, Robert, with specific to like the single family rental companies.
Look, that's an interesting point, and what I would say to that is that he has his financing locked in on each property for 30 years, then he's essentially at all-time highs. AMH might have, you know, debt going out. I mean, I could just look it up right now really quick, see what their maturity ladder is. Yeah, they have debt due in 28, they have debt due in 29, 31, 32. So they have debt that repriced. And it's actually trading under 7%, which is quite low for a corporate. But you know, like there's a very small spread there between there and like probably the closest treasury, like maybe 80 basis points. But the point that I'm just making is that their debt reprices and their cost of financing reprices. Whereas if he's got a 30-year mortgage, that's not his freaking problem, you know? So that could be your answer right there. I'm not saying it necessarily is. You know, there could be equity risk premium on there as well. So, you know, you got to pay management, which even though there's obviously scale, but you know, I'm just throwing out a bunch of reasons why it could be. I am not an expert in those companies, though. They're not necessarily that hard to wrap your arms around. I would say that I did look at their multiples recently, just like tangentially to see if like another company that I owned, in worst case scenario, could they spin out some assets that they had to work out or something that were single family homes. And these guys trade at really high multiples still. They trade at higher multiples than any of the actual apartment building REITs, which to me you would think is a better business because you know, you would think that there's some efficiencies in having a building versus scattered homes, but these things trade at higher multiples, so they're still very highly valued businesses. maybe when rates were lower, they were just even more highly valued.
Yeah, I think that's super well said. I mean, I think that makes a lot of sense. Like even if you would match the asset dollar, house for house, to your point, it's just it trades on a different, it trades differently and it's financed differently and it's structured differently. So it's just really not. It can never be apples to apples, no matter how bad you want it to be. No, I think that makes a lot of sense. Cool. Before we get into what else, Jimmy? What's top of your mind?
Well, I'm glad I didn't double down on my Bitcoin short. We're kind of in that fuck around and find out stage. I mean, look at the rally in Chinese equities. People are coming up with reasons why, whether it's geopolitical risk, capital flight risk. Anytime you have these kind of declarations, there's a lot of flight towards this type of asset. I'm gonna let the music, or I'm gonna let the dust settle first. I think if you look at Hedgeye over a more recent duration, it's flipped a bullish trend on Bitcoin, and the trade is also kind of up there. Now it's kind of, skyrocketing from an overbought level, which is sometimes what you see happen. And I don't know what the next line of defense is, but, I was eyeing 32K for a while, and now we're kind of way beyond that. But, the market's kind of faded from the open. So I'm still very much looking at this as a proxy for risk, as a proxy for, I think we've talked about like the QQQ trade, the small cap trade, a lot of these pair trades that got unwound a little bit. But I still think the worst is yet to come. So if anything, this is probably a bull trap. There's good volume today, but I just don't see the other side. Like. This is a joke. It's like, are you going to sell this time around? Are we going back to 67? Like, what's the deal? One of these things is definitely not like the others. So, like I said, until there's more confirmation, I'm not gonna short necessarily today and like bet against myself or bet against some arbitrary figure. But I mean, I'm still biased to the short side there. And I posted that SL Green chart just because REITs are in the pits again. This is a company, 2 decades of equity value, right? This is like, if you work in real estate, like they're one of like the Goldman Sachs. They're if you're like if you're in a M&A or acquisitions like associate as a SL Green, that's a sweet gig. For someone coming out of college or coming out of banking, and so a lot of respect to a lot of these real estate players who've been around for multiple cycles, but the equity is just not there, right? There's some real risk to these asset classes, and I try not to get too much in the weeds because you can get into this doom spiral. But the writing is on the wall for a lot of these real estate sectors that I used to be heavily involved in, and I'm not sure what changes. I think Robert, your profile says it all. Like we're in a period of rising rates now. Did you guys see the Gunlock presentation, by the way? Maybe it was like a week or two ago. He was at some other club. He kind of busted out his 2016 pitch book around Brexit about how rates can never go up. And, I think he's not the first to say it, but like we're in a period where we've broken all those correlations, and whatever used to exist because we had a secular, bull market in bonds, now the other way, it's like shit can get kind of scary. How are we going to service our debt? How are we going to do these other things? And, there's no blend and extend. So I think we see more credit events. I think we see more defaults, over the next couple of years, certainly in real estate.
Yeah, I think that makes a lot of sense. I think it's really interesting back to tying the Bitcoin thing in, where it's just like, it's clear whatever's going on, clearly it's like a global liquidity thing. So if you look at like just the home builders, so when we spoke to Robert last was March, and let's see that they actually kind of dipped into that, and so we've kind of talked to him towards the ITB was like 66, it ran all the way to 90 and then retraced to about 72 since we spoke. But it's all an interest rate thing, right? Like since rates started, since it became clear Who was the guy, Robert? I was just looking to see your. Oh, it's B. Fleckenstein. You posted this on the other day about Fleckenstein. I watched that interview. It was really good. Fleckenstein was sitting down with the Wealthion guy, and they're talking about all this stuff. And he's like, "Look, and I really like B. Fleckenstein. Unfortunately, he blocked me on Twitter, but seems like a great guy." And he said, "Look, interest rate moves are generational." He's like, "You could spend the rest of your career, we could spend the next 30 years with rising interest rates." And obviously, we look back at long-term charts of yields, and they've been going down for 40 years, roughly. So where am I going? I just think it's interesting how liquidity really drives so much of this. But maybe let's go back to the juice, back to the goods. Robert, from here, obviously it sounds like not a ton. Tell me, what's changed most since we last spoke in March fundamentally about the sector that you cover closest, which is the homies?
Look, I would tell you that I've been listening to Bill Fleckenstein for probably at least 5 years, and I actually was just sharing how cool I thought it was that they were sharing the video on Twitter. I actually didn't even listen to it. I don't think I need to know what he's gonna say anymore, frankly. But I mean, I think we could be entering another era of financial repression eventually. Like the government does need to fund deficits for the foreseeable future, and we might see some like real continuations on inflation if China decides that they want to be very tough on the U.S. and dictate terms, because they have the manufacturing capacity, and we're still working to rebuild it. So how that plays out for real assets, you're as good as guess as mine. But I like real assets in that type of world. And in terms of home builders, the rates have went up, and so that's the only thing that really matters in the short term. But that gives them that relative advantage over the existing homes. And all the stuff I bring up with rates is to say is, like we shared that the article that showed that emerging markets rates for a little bit ticked actually below like U.S. government yields. And I think you need to think about how many pensions can set it, forget it, and with higher allocations to treasuries, and then like take so much less risk and meet all their short-term goals. So like there really should be more demand for that type of thing. So like, I would take, I don't want to say like rates going back to zero, but like maybe calling them more range bound and saying that they're set to go higher forever. Which, look, that, like to Jimmy's point earlier, people who financed mortgages or commercial mortgages when rates were at zero or even at 2.5 could lose equity as rates go up. But for people buying brand new assets, or people buying those assets out of bankruptcy, you're actually, depending on your starting point or your purchase price, you can be very well primed to see good returns on real estate going forward. It's more people who locked in unfavorable, let's say not unfavorable, but they paid an unfavorable price because they thought that rates would stay low forever, that are going to be hurt. And so home builders, as I look, I've seen communities like that are public in California say that their sales pace haven't even fallen that far. There's a shortage of housing in California. So if you need a new house, and there is sort of this reverse arbitrage where, your taxes are going to go up a lot if you buy a home, you're not going to be able to pay the price that someone else thinks their home is worth. You're going to have to go to a new home builder. And so for people who are locked into their mortgages across the country, you're more likely to buy a new home, get a lower purchase price, and get a lower mortgage rate. The thing with home builders is, if they care more about volume, they can take margin out of the home in other ways. If you listen to calls, you'll hear about value engineering, which is just like a corporate speak for, we're taking costs out of the home, we're making it lower quality, which is another form of inflation, by the way. Shrinking the square footage of the home, it's shrinkflation. It's just on a bigger object. So there are other ways to pull costs out, and I think on a relative basis, home builders are actually primed to do well. Like I said earlier, they're in a good financial position. Now, you are much more of a momentum guy than me, Turtle. So you tell me, like, what do you think, like, of like the momentum? I'm not saying like go out here and fight the tape, but I am saying that these are well capitalized companies that I don't think are going to be the ones forced to puke out their assets. That's going to be more your office landlords or other highly levered companies. So I just don't think you're going to see that in this sector. I've seen, it's called Dream Finders Home, I think, found capital at 8.5%. If I go back and look at whatever their latest bond issue was, I saw some companies Canadian issued a new deal. Small private builders have gotten some deals off below 10%. So they're getting deals off. Dream Finders Homes, probably got a deal off cheaper than some people are going to be getting mortgages soon. And so while I still think that, mortgages could come in, the rates on those could come in over time. The point that I'm just trying to make is that builders are.
No, loud and clear. I think that makes a ton of sense. Got some feedback at the end there. I hope you're done, but yeah, I think that everything besides that sounded good and makes sense. So no, I'm with you, and I think like from a momentum standpoint, no, the home builders look like dick. I mean, that's what I posted that here to the nest. They're the least. They have the lowest amount of strength of signal strength of all the. If you include them if you make them the 12th sector, which I do here in one of our tweets, I'll post it to the nest right now, actually. But if you make them the 12th sector, they look the worst. But that's just really, to your point, it's just a function of interest rates, though, really. And also, when you're looking at this, like, there's so many ways to skin a cat. But if you're looking at this momentum stuff, I think you have to also consider, so you're following trends. You have to also consider things, or you might want to also consider things that are extremely oversold, right? And we, at Swami Research, we call it a fractal reversal signal, right? I have a guy I work with, Joe Catanzaro, who's very good at this stuff, and he calls those out. But but that basically is just like oversold the shit signal. That's the other way to say it. So and the point is, we're getting that now, or getting close to that now on, on the 10-year treasury, your overbought signal is what I mean. The 10-year treasury yields overbought, the PFIX is overbought, TLT is oversold, right? So the point is, the point is that it's clearly it's a macro canary, and it didn't like interest rates going up, and I think that's maybe in addition to everything you said about the fundamentals and the relative. That's not who's going to be getting carried. Basically what I heard you say is essentially that's not who's going to be getting carried out this cycle. And so from that standpoint, almost like if the 10-year yield stops going up here, then then I think they look really interesting. So that's that. Let's see. Let's jump to a couple tickers. Unless Jimmy, you got anything? Maybe we jump to a couple tickers and get everybody out of here.
Yeah, let's talk tickers.
Yeah. Let's start with the most undercover or under the radar ticker you gave us last time that really crushed the ball. That I think was a really interesting story was that 4-star. That was really cool. It was like so they spun out of DHI. They have a big overlap in ownership with DHI, and it doubled. You gave us the ticker, it freaking doubled in 3 months, and then obviously it's backed off considerably with rates, but it went straight up every day after you gave it to us. That was fun. And what do you think now? It's still interesting business, still a reasonable valuation. But what do you think on FOR?
Yeah, look. The thing about 4 is it is below book value again. So like you're buying some assets below replacement value. And DHI, which I think I also said like I'd like to own on the last one, but that it was a little rich for me, is like the parent company, and they are the largest by homes delivered in the country. And they said that they were currently buying 1 out of every 5 lots that they end up delivering into a home was being bought from 4-star, and that their plan was to move that to 1 to every 3. So basically, they told you that like even if our business shrinks, like 4s is going to grow as and that's really comes down to the fact that like 4 is like a way for them to option lots, which is like just a way for them to gain leverage without actually taking on debt. And so I just thought it made a lot of sense, and I still think it makes sense. And below book value, it's starting to make a lot of sense again. I'd like to see it trade down. It's probably like 90% of book value right now. So like, wow, that's nice. It's not like it's not like the most incredible discount I've ever seen, but it definitely is starting to make a lot of sense again. And look, it's a well-run company. It's got a very, very clear and easy to understand growth tailwind. And yeah, I mean the story is just it's owned and delivers lots to the biggest builder in the country.
Love it. No, it makes a lot of sense. Basically, there's if you one way of thinking of it is like the rise in interest rates, and especially the work from home stuff, really played into like the scarcity of capital and scarcity of home ownership opportunities. And so just buy the fucking land, man. Makes sense. I don't know. To a simpleton like me. And DHI, you mentioned DHI. You definitely were talking about DHI last time. That made a lot of sense to me. I like trafficking more and like the bluer stuff. So that was very interesting and good for me. I like DHI. Do you have different thoughts on DHI or kind of the same thing? Still a kind of blue chip home builder, looks good, kind of like just like you've kind of been saying about home builders in general.
Yeah, look, I mean, because of all the stuff they've done with option lots, they're kind of trading at a multiple of the price to book, which I like. I would buy the stock, I think, but I don't think I'd want to buy it right here, frankly. One I do like is Beazer. It's BZH. It trades at a big discount to book value. It's probably at 2/3 of book value right now. And I expect them to report solid results. And they're growing their community count, which is, they've been shrinking it for years. They came out of bankruptcy in 2002, 2007, 2008. And, ever since they've been paying down debt, and they don't pay cash taxes. They show taxes because they write down their NOLs, but it's a company trading at 2/3 a book, growing communities, and I think they're going to report good results. And they traded up to book value at their last earnings and kind of have gotten crushed with rates. And I was a little too early to this one in buying it, just because I was like, oh wow, I've got this earnings catalyst. It's only 5-6 weeks away, and in the meantime, rates have just crushed me. So maybe I should have been short TLT as a hedge, but I was long outright, and it hasn't been fun. But I'm not going to lose. I'm not going to lose like my nest egg over it. It's a well-run company, and I'm hoping it trades back to book value. So you can get it at a better price than I did. BZH.
Yeah, where's that? Where's their geographical? Where are they geographically? Are they concentrated somewhere?
They're national, but they're headquartered in Atlanta. I mean, they're probably in Phoenix, the Carolinas,
they're pretty, yeah.
Florida, California. Like, I don't worry.
Okay, they're not that. I was thinking
yeah.
of the. I was thinking of the New Mexico. Isn't there? There's one that's like more of a New Mexico play. That's not these guys. That's somebody different. Cool. Okay. Cool. I like that. BZH. I'm posting this chart to the nest right now. It's pretty wild. Like you said, it got shellacked back in the back in the GFC. Cool. Well, what do you? Anything jumps out that you don't like? If we're if you want to get fancy, long and short some stuff. Great way to lose money on both sides of a trade is to get cute and long and short it. But what is anything you don't like?
I mean, just from following it back when I was at my old employer, I don't like TMHC really. TMHC, like they would be like, "Oh wow, we really ramped up our sales pace to like 3 this last month," which means like they would sell 3 homes in a given community over a whole month, and like that was like they would be like bragging that that was like a good sales pace, and like that, like for some builders, like 3 might be the low end where they hope they could get to 4 sales a month, and they are a more upscale builder, but like just like they did an acquisition, I remember, where there ended up their community count ended up being smaller year over year, which like is insane. Like you like when you combine the two companies, they ended up having less communities or store counts than they did when it was a standalone company the prior year, which is just obscene. And so, look, I'd be lying if I told you that like I was following the company very closely today, but just stuff like that I remember like didn't seem like the best run company. And yeah, if I had to short any home builder off the top of my head, it would be them.
Good deal. Good deal. Jimmy, what else? What else we got for Robert here?
I'm here for the open mic component of it, and it kind of it's funny when we talk about these names, right? Because some of these names I've covered, some of these names I've heard of, others not as much. But this is like 1:30 at the bar, and the bar closes at 2. And all my bags, all the names I have great fundamental due diligence on, they're like a 4. And there's a bunch of 7s and 8s in the bar. I'm trying to get home and not miss my Uber ride. You got VIX coming back up. You got the consumer under distress. I'm not going to pitch all the narratives, but like, I think this market's going to fall apart, man. And it's just it's hard to pay attention to individual names right now when I'm still very much macro focused. And, I'm as much of a, fundamental degen as you get, but I do respect the technical analysis. And there's a lot of things that are breaking that I just don't like. And when I see risk free at 5.5%, I'm going to take that. And I'm going to, maybe I lost too much money in SPACs and in all my small cap bags, but like even this time around, with Bitcoin pumping, there's just not as much retail enthusiasm. And I think the institutional front too, like we've had a crazy year with the dispersion between large caps and everything else in the S&P and QQQs. I'm not saying I'm telling my clients this, but like, hey, I'm going to try to lock in the gains if I can this year. If I had gains in 23, I'm going to try to lock it, take it to the bank. And, I still think the worst is yet to come. And maybe that clouds my view a little bit on the individual companies. But again, going back to the technical analysis, there's just a lot of falling knives to catch. And yeah, I think we just got to be careful.
No doubt, man. And I think that that's there's clearly, like I said, there's something that's happened. Look at all these moves, right? Like where it's like so much of the move happens at night. Like we'll have these like sell-offs, and then every morning it's like the tech rallies from the 10 years penetrating new highs. The Nasdaq's down 0.5% in the pre-market, and then we open down 20 basis points and then rally from there. So it's just like, I guess where I'm going is just that there's clearly such a big picture macro thing going on that's just so deep water and hard for me to understand that yeah, you're right, that's such an interesting thing to keep an eye on. However, what is so interesting, but then why home builders and housing and all this shit is just so interesting to me is because that, again, is what kept, I think, the consumer afloat, right? The housing price appreciation, the average consumer, I believe, had $50,000 of housing price appreciation through COVID. That kept, that was so key. And then you
100%.
met these huge forces of structural underdemand and millennials about to have kids and household formation, and then it just kind of went, and then you've FAFO, man. You lock people in their houses a long period of time, and you artificially push down rates and blah blah blah. But it's like you create this concoction, and so, but to tie it all back to Robert, it's so interesting that like real estate and housing is really where that flows through, right? It's like, again, the if you own 6 rentals, you're doing great, and you're really, you're in a very good position. And we've created winners and losers with this interest rate rise. And I'm with Robert. 2 sentences, and let's get back to open mic and just, let you guys go or wrap from there, or just chat for a couple more minutes. But my last point there is that clearly, to me, this is just such an interesting thing to watch play out, because I am with Jimmy. I do think that's, it's coming, right? Like this, I believe it's coming, but I don't know. And what I also want to say is that I don't want to not, I think realty income at $49 or whatever. I mean, that's not Robert's, ball of wax exactly, but like these triple nets are just beat to hell. These, I think EQR yielding 4. It's like, that's not bad. If I go out and buy a rental, I'm not going to get a 4% increasing dividend with no work. So I just think real estate is such an interesting place to watch this shit play out. Talk about real assets. Nothing's more real than your house, man. So Robert, just back to you, man. I mean, closing. Here's your put the bow on this Sunday for us. Thanks for chatting for a minute. I just really appreciate your expertise here, and I would like to kind of just keep in touch with you. But what closing thoughts do you have for our massive audience here?
What closing thoughts? Look,
it's going on the YouTube, so I got 212 more viewers coming for you. So
okay.
We're about to do numbers, Robert. So think this through.
I think that these companies are pretty well positioned in terms of financially. So when we speak about companies that are going to get hurt from higher rates, maybe these guys' sales will get hurt, but I think they'll still outperform on a relative basis versus the existing home market and pick up share there. But these aren't going to be the companies that get restructured. The types of risks that were embedded in home builders in 2007, 2008, with like just being over levered and like these companies going BK, isn't there this time around. And so, like, I just don't see the risk in the stocks at this level. Do I think that they were the home runs that they were? Do I see the home runs that I saw with 4Star the last time we spoke? No, but I do think Beazer, for example, like, gives you a decent shot. Like, if you can buy these things at significant discounts to book value, I just don't see how you get hurt long term.
Dude, I love it. I love it, man. I think it's a great that's probably a great place to end it. Just a quick check-in with our housing shark here. Sharp, I should say, Robert Heimowitz. So thanks so much, Robert, for coming out. And you're the man, dude. Let's talk soon. I mean, I think that like we kind of all said, I mean, there's just man, these 5% on the 10-year and 8% on the 30-year mortgage is really a tough pill to swallow, when 18 months ago you could have got such a better rate. But it's still household formation. It's still happening. And so we get to watch this all play out. So with that, Robert, you're the man. Thanks for coming out. Good talking to everybody. Thanks for listening.
Thank you so much for coming, Robert. Well, like I said, we'll reconvene and see what happens, right? Sometimes this is like a time and space thing where we just have to see these forces play out, and then we'll update our thoughts accordingly.
You work for 2 funds now. One's our little garage band LARPing hedge fund here, and one's the real one. So,
fuck yeah,
you're one of these people working 2 jobs. These work from home badasses. Cool. Have a great day, guys. Peace.
See you guys.